Every time you turn on the news or open social media right now, it feels like the world is on edge. With the recent geopolitical tensions making headlines, there is a lot of fear. And when there is fear in the world, there is fear in the stock market. You might be looking at your 401k or your brokerage account and thinking, should I pull my money out? Is the market going to crash? Today, we are going completely noise-free. When you crunch the numbers and look at historical market data, which is exactly what we are going to do. Today, the numbers tell a very different story than the panic you see on TV. Let's break down exactly how these global events impact your wallet, inflation, and what you should actually be doing with your money right now. First, let's talk about stock market volatility. It is completely normal to see the S&P 500 and the Dow Jones take a hit when global conflicts arise. Investors hate uncertainty, but here is the historical truth. Markets overreact in the short term, but they are incredibly resilient in the long term. If we look back at major geopolitical crises over the last 50 years, the initial shock usually causes a dip, but historically, within 6 to 12 months, the market not only recovers but often hits new highs. Selling your index funds or stocks right now locks in your losses. Time in the market always beats timing the market, unless you need that cash tomorrow. Zooming out and looking at the big picture is your best defense. Now, what about the money you spend every day? The biggest, most immediate impact of global tensions is on the supply chain, specifically crude oil. When oil-producing regions are unstable or trade routes are threatened, the cost of oil spikes, and you know what that means. Higher prices at the gas pump. But it doesn't stop there. When it costs more to fuel the trucks that deliver goods, those costs get passed down to you at the grocery store. We could see a temporary spike in inflation. This is exactly why keeping a strict budget and tracking your monthly expenses is more crucial right now than it was 6 months ago. During times of crisis, you always hear about safe haven assets. Big institutional investors often move their money away from risky stocks and into safer bets like gold, commodities, or U.S. Treasury bonds. Gold tends to hold its value or even go up when paper money or stocks are shaky. Treasuries offer guaranteed returns backed by the U.S. government. But should you rush out and buy gold? For the average everyday investor, completely restructuring your portfolio out of panic is usually a bad move. It's okay to have a small percentage of your wealth in these safe havens for diversification, but don't abandon your core investing strategy. So, what is your game plan? Here is the actionable advice you need right now. Number 1. Do not panic sell. Turn off your portfolio notifications if you have to. Number 2. Continue dollar cost averaging. If you have automatic contributions going into your Roth IRA or 401k, let them run. In fact, a dipping market means you are buying shares on discount. Number 3. Audit your emergency fund. Make sure you have at least 3 to 6 months of living expenses sitting safely in a high-yield savings account. That is your financial shield against any storm. Global uncertainty is scary, but your financial strategy shouldn't be based on fear. Stick to the fundamentals. If you found this breakdown helpful, please hit the like button so this video can reach others who might be panicking right now. Subscribe to the channel for more calm, number-driven financial strategies. Let me know in the comments below. Are you buying the dip or holding your cash right now? Stay smart, stay invested, and I will see you in the next video.